The initial $100,000 is like an obstacle that most folks never manage to overcome. It's not due to bad luck or because the system is stacked against them. They stumble because they lack an understanding of the mindset behind their own foolishness. I've spent 70 years observing clever individuals undermine their own efforts with the same predictable mental blunders. And I can tell you this for sure, your mind is set up to keep you broke. Let's be honest here, you're up against millions of years of evolution that hardwired you for instant rewards. Your forebears who saved food for the cold months didn't pass on more genes than those who gobbled it up right away. But we're not living in caves anymore. The game has changed, yet your brain hasn't gotten the update. That's the first issue you need to tackle. Money is freedom. Money is power. Money is what separates you from being just a biological machine, trading time for money and becoming a logical thinker who can make choices without being forced. Without that initial $100,000, you're just another worker hoping your health stays good and your boss remains satisfied. One health crisis, one company shakeup, one little economic hiccup, and you're done for. I'm not making this up. I've seen it happen during the Great Depression, through every downturn since, and in 2008 when folks lost it all. Those with money had choices. They could scoop up assets while everyone else was in a panic. They could ride out the rough times. They could take smart risks because they had a safety net. Those without money got crushed, not because they were foolish, but because they had no power. Here's the hard truth that no one wants to admit. Reaching that first 100,000 has nearly nothing to do with being smart. I've known incredibly bright individuals who ended up broke, and average thinkers who amassed wealth. The key difference wasn't intelligence. It was being rational. It was all about spotting and tackling the mental habits that lead people to make foolish choices with their cash. Let me explain what you're really up against. You might believe you're battling low pay, bad luck, or the system itself. That's not it. You're actually up against yourself. You're dealing with what I refer to as the psychology of human error in judgment. There are 25 ingrained tendencies that evolution equipped you with to thrive in groups, not to accumulate wealth in today's markets. The first tendency that's holding you back is the way we respond to rewards and punishments. It's a straightforward reaction. You tend to do what gets you praise and steer clear of what brings you criticism. Seems fair enough, right? But in today's world, society rewards spending and punishes saving. You get a shiny new car, and everyone's singing your praises. Meanwhile, you're driving an old clunker while saving diligently, and folks think you're a loser. Your whole social circle is discouraging the very actions that could lead to your financial success. Every ad, every post on Instagram, and every chat with your friends is just reinforcing the wrong motivations. Your brain has developed to really care about what the group thinks, because being excluded from the group could mean your survival was at risk. So you end up spending money you don't have just to impress folks you don't even like. And then you're left wondering why you're struggling financially at 40. This isn't just some philosophical idea, it's biology working against your money goals. The second issue is social proof. Humans are like copycats. If everyone around you is driving fancy cars and jetting off to Europe, your brain sees that as the right way to act, regardless of the fact that they might be buried in debt. Your subconscious notices the crowd moving in one direction and urges you to jump on board. This is how you can find yourself with a negative net worth while trying to keep up with the neighbors. I'm about to share something that might sound a bit harsh, but it could save you years of struggle. The truth is, most people lack financial skills. Most folks will put in 40 years of work and end up with nothing to show for it. A lot of folks are just going along with a plan set up by marketers who are eager to take every dollar they make. If you just follow what everyone else is doing, you'll end up with the same results as the crowd. That means a lifetime filled with money worries and a retirement that relies on government assistance. The third issue is envy and jealousy. This one can be especially harmful. You spot someone with a fancier house or a nicer ride, and something deep inside you starts to scream. If you give in to that scream, it could cost you everything. I've seen envy wipe out more wealth than poor investments ever could. There are people earning $200,000 a year but living paycheck to paycheck because they can't stand that their coworker bought a boat. Here's the principle of inversion that I want you to really remember. Instead of asking, "How can I get rich?" flip it around and ask, "What keeps people poor?" The answer becomes clear once you take a closer look. People remain poor because they struggle to postpone their desires. They stay poor because they worry about what strangers think of them. They remain broke because they allow their feelings to take precedence over their calculations every single time. The math is painfully straightforward. Spend less than what you make. Invest the remainder in assets that generate income. Wait, that's all there is to it. That's the entire deal. However, just because it's simple doesn't imply it's easy, since you're battling a mind that craves instant gratification, status right now, and comfort at this moment. Your mind is yelling at you to prioritize today, while your future self ends up footing the bill. The fourth tendency, contrast and misreaction. Your mind doesn't assess things in absolute terms. It compares them instead. You might feel wealthy until you encounter someone with more money. You may feel poor until you come across someone with less. This tendency leads to predictable, irrational behaviors regarding money. You receive a 20% raise and promptly upgrade your lifestyle by 25%, because you're measuring yourself against a reference point that has nothing to do with reason. Let me share a specific example. Back when Earl Nightingale and I were just starting out, we didn't measure ourselves against successful folks. Instead, we looked at our decisions through the lens of opportunity cost. Every single dollar we spent on things we didn't really need was a dollar that wouldn't be able to grow for years to come. That's the logical way to think about it. But honestly, hardly anyone sees it that way. They're too caught up in comparing their ride to their neighbor's ride. Now, let's talk about the fifth tendency, deprivation and superreaction. People really dislike losing what they already have way more than they enjoy getting something new. This is why folks tend to hang on to losing stocks for too long and let go of winning ones too soon. It's also why they struggle to cut unnecessary expenses from their budgets. They feel the pinch of canceling a luxury subscription like it's a huge loss, even though not signing up in the first place wouldn't have bothered them at all. Your mind reacts to giving up that daily coffee shop visit as if someone's snatching food right out of your hands. Meanwhile, you're shelling out $1,500 a year. That money could be growing instead. In 20 years, that's $50,000 you throw away because your mind can't cope with the idea of letting go of something. Let me break down compound interest for you, since everyone acts like they get it, but in reality, very few do. Compound interest is the strongest force in finance, but it's totally pointless if you don't have anything to grow. That's the real issue. Folks read about Buffett compounding at 20% for 60 years and think, awesome, I'll do that too. But they're sitting on $500 and juggling 3 credit cards with 18% interest. They don't have a compound interest issue. They have a capital accumulation issue. Here's what compound interest genuinely looks like. At first, it's pretty disheartening. You stash away $6,000. You make 10% on that. That's $600 before taxes. Then your car breaks down, costing you $900. You start to feel like an idiot for even trying. This is where 90% of people throw in the towel. They can't stand the mental struggle of watching tiny amounts grow slowly while life keeps hitting them hard. I never got pumped about compound interest. In my 20s, I was hustling hard, struggling, and seeing minimal returns that couldn't even cover a getaway. It was all about sticking with it, even when it felt tough. That's where real wealth is built, not from sheer genius. It comes from that stubborn determination to keep going, when throwing in the towel seems like the easier choice. The sixth tendency is about availability and misjudging things. Our minds tend to give too much weight to recent flashy examples while downplaying the actual statistics. You might know someone who struck it rich in cryptocurrency, so you think that's a solid route, overlooking the countless others who faced huge losses. You recall that one stock tip that paid off and conveniently forget the 10 that flopped. This mindset leads you to chase after high performance and buy at the peak. The smart move is to disregard those stories and rely on proven systems. But let's be real, humans aren't exactly rational. We're driven by narratives, and those narratives often mislead us about what's likely to happen. Every lottery winner who pops up on television causes a million folks to waste their cash on tickets because that captivating story overshadows the cold, hard facts. Let me share the framework I use. I like to call it inversion. Instead of wondering what steps I should take to achieve success, I prefer to think about what I should steer clear of to avoid failure. That second question holds way more value because the major setbacks usually stem from a handful of foolish choices that anyone with a bit of self-control can dodge. Steering clear of foolishness is way more crucial than chasing after brilliance. This isn't about being humble, it's just basic math. If you can sidestep disasters, everything else tends to fall into place. But one big mistake can wipe out years of hard work. I've witnessed it happen to folks who were way smarter than you could ever imagine. They got too clever for their own good. They got greedy. Or they just stopped paying attention, and suddenly 4 decades of building wealth disappeared with one bad call. Let me break down what foolishness looks like in real life. Foolishness is taking out loans to buy things that lose value. Foolishness is racking up credit card debt while acting like you're an investor. Foolishness is believing you can outsmart professionals who dedicate 80 hours a week to analyzing the markets. Being foolish means purchasing a home that's beyond your means because you're scared of missing out forever. This isn't just a rare occurrence, it's what a lot of folks do. The 7th trait is being misled by authority figures. You tend to trust these authorities even when they're mistaken. This instinct developed because in tribal communities, going against the leader could cost you your life. However, in today's financial world, those in positions of authority are often pushing something on you. Financial advisors earn commissions. The media thrives on sensational stories. Economists are out there promoting their latest books. They're all looking out for their own agendas, not yours. And yet, your mind still sees them as wise elders concerned about your well-being. Let's be honest about financial advisors. A lot of them are just average salespeople who wouldn't outperform the market, even if it was a matter of life and death. They'll take 1% from you each year to place you in pricey mutual funds that lag behind index funds. Over 3 decades, that 1% fee can add up to you retiring with 30% less than you could have. Sure, here's a reformulated version of the text, but they've got a fancy office and are all dressed up in suits, so your mind just screams to trust them while they quietly take your money. The smart move is pretty straightforward. Invest in low-cost index funds. Keep them for the long haul. Ignore all the noise. But that kind of advice doesn't line anyone's pockets except yours, so you won't hear it shouted from any platform. Instead, they'll make it all complicated, throw in some disclaimers, sell you subscriptions, and make you believe that investing is something you need special skills for. It's not. What it really takes is discipline, which you probably lack. But that's a whole other issue. The eighth tendency is avoiding doubt. Your brain really dislikes uncertainty. When you're unsure about something, it creates mental discomfort. So you rush to get rid of that doubt by making a choice. Any choice, even if it's a poor one. This is why folks panic and sell during market crashes. The uncertainty of whether things will bounce back is just too much to handle. So they end up selling at the lowest point just to escape that feeling. I've been through more market downturns than most people have had birthdays. Every single time, the same scenario unfolds. Intelligent individuals who grasp the concept of compounding on an intellectual level completely lose their composure when their investments take a nosedive of 30%. The emotional distress overshadows their reasoning, leading them to make the very choice that ensures a lasting loss. They sell. Here's what you need to grasp. Market fluctuations aren't a flaw. They're the very element that generates returns. Stocks reward you with a premium for tolerating psychological discomfort. If owning stocks were enjoyable and straightforward, they would yield 2% like bonds. They yield 10% because most folks can't stand seeing their wealth swing dramatically. That volatility is your reward for staying level-headed when others are in a panic. However, your mind doesn't operate on 30-year timelines. It focuses on the present moment. When the market dips by 20%, your amygdala goes off like you're being hunted by a predator. Every instinct yells danger, flee, take action. The sensible move is to do nothing, or even better, buy more. Sure, here's a reformulated version of the text. But they've got a fancy office and are all dressed up in suits. So your mind just screams to trust them while they quietly take your money. The smart move is pretty straightforward. Invest in low-cost index funds. Keep them for the long haul. Ignore all the noise. But that kind of advice doesn't line anyone's pockets except yours. So you won't hear it shouted from any platform. Instead, they'll make it all complicated, throw in some disclaimers, sell you subscriptions, and make you believe that investing is something you need special skills for. It's not. What it really takes is discipline, which you probably lack. But that's a whole other issue. The eighth tendency is avoiding doubt. Your brain really dislikes uncertainty. When you're unsure about something, it creates mental discomfort. So you rush to get rid of that doubt by making a choice. Any choice, even if it's a poor one. This is why folks panic and sell during market crashes. The uncertainty of whether things will bounce back is just too much to handle. So they end up selling at the lowest point just to escape that feeling. I've been through more market downturns than most people have had birthdays. You might want to think that your job is secure, so you don't really need a big emergency stash. These aren't bad feelings, they're totally normal, but they can keep you broke if you let them mess with your common sense. What I've always done is set up some counter incentives. Whenever I feel the urge to splurge on something silly, I figure out what that cash could grow into if I invested it for 30 years. That fancy car isn't just $40,000, it's actually $200,000 for retirement. When you look at it like that, suddenly keeping the old ride seems way more attractive. Now, let's talk about the 10th tendency, which is self-serving bias. You think you're smarter, more capable, and luckier than you really are. 90% of folks believe they're above average drivers. 90% of investors think they can outsmart the market. This mindset can make you overly confident and open to mistakes that someone with a realistic view of themselves would steer clear of. I've met a lot of really smart people. I've been lucky enough to collaborate with some of the brightest individuals in the business world. Yet I've never encountered anyone clever enough to consistently outsmart the markets through trading. The odds are stacked against you, the fees are against you, the experts are against you, and even your own mindset is against you. Still, folks keep trying because they can't fathom that they aren't unique. Here's what being unique truly means. Being unique is having the self-control to live on less for 10 years. Being unique is sticking to your savings plan when your investments plummet by 40%. Being unique is disregarding your brother-in-law's hot stock recommendation. That's unique because nearly no one can pull it off, but it isn't glamorous. So people keep pursuing the dream of getting rich through clever tricks instead of exercising patience. Now, let's dive into debt, as that's where I notice the most outrageous foolishness. Debt is the complete opposite of compounding. When you have money invested, it works in your favor. But when you have debt, it compounds against you without mercy. A credit card with an interest rate of 18% is just piling on your financial struggles while you're not even aware of it. I've seen folks earn $100,000 a year, yet still live from one paycheck to the next, because they put everything on credit: cars, furniture, vacations, even their everyday expenses. They believe they're doing great, but in reality, they're just constructing a cage, one monthly payment at a time. Here's the math that most people overlook. If you're carrying credit card debt at 18% while trying to invest in stocks that might give you a 10% return, you're essentially paying an 8% fee just to feel like an investor. That's not being savvy, that's just wishful thinking. The smart choice is clear. Pay off all your debts before you even think about investing a single dollar. But that means facing the fact that you can't keep up with your current lifestyle, and people will go to great lengths to dodge that reality. Now, let's talk about the 11th tendency, which is reciprocation. When someone does something nice for you, you feel this urge to return the favor. Salespeople are well aware of this. They'll offer you free samples, free trials, and free consultations. So your mind starts to feel like you owe them something. This is how folks wind up purchasing stuff they don't really need from people they just met. The credit card companies totally get this. They offer you rewards points, cashback, and access to airport lounges. You think they're being nice, but in reality, they're charging businesses 3%, and those businesses, in turn, hike up their prices to make up for it, so you end up footing the bill for your own rewards. On top of that, the whole psychological trick of chasing points makes you spend even more. They're not really giving you anything. They're just playing on your instinct to reciprocate, to get you to spend more. I don't get involved in these games. I've never focused on maximizing credit card points. I've never been interested in status or perks. The mental effort folks waste on loyalty programs would be better directed towards figuring out how to earn more or cut back on spending, but that's a tougher task. Instead, they get caught up in chasing an extra 0.5% cashback, while overlooking the bigger chances. The 12th tendency is an inflated sense of self-importance. You believe you're one of a kind. You think the rules don't apply to you. You imagine you'll be the one who strikes it rich through day trading, flipping properties, or launching a dropshipping venture. This mindset leaves you open to every get-rich-quick scheme that pops up because they all say what you want to hear. You think you're clever enough to outsmart the system. Here's a little secret. The system usually wins. Those who build wealth do it through steady, unexciting capital growth over many years. They're not extraordinary. They're disciplined. There's a key difference. Being special means you have unique skills. Being disciplined means you stick to the straightforward path even when it's tough emotionally. The first 100,000 isn't about being special. It's all about not being foolish. Don't invest in things that lose value. Avoid carrying high-interest debt. Don't upgrade your lifestyle every time you get a pay increase. Don't get caught up in chasing high returns. And definitely don't panic when the market dips. If you can steer clear of these mistakes, you'll build up your wealth. It won't happen overnight. It won't be thrilling, but it will pay off. Now, let's talk about the timeline, because this is where people's expectations can really trip them up. For most folks, growing $100,000 from nothing takes around 7 to 10 years of serious saving. That's not just a guess. It's simple math. If you set aside $1,000 each month and earn 7%, you'll reach that goal in roughly 8 years. Most people can't handle 8 years of discipline. They want quicker results. So they start searching for shortcuts. They stumble upon options trading or cryptocurrency, or some expert promoting a course on making passive income. They convince themselves they can outsmart the system. Then they end up losing money, feeling discouraged, and giving up entirely. They would have been better off accepting the timeline and just putting in the work. The timeline seems pretty unfair. I totally get that. You put in the effort, you make sacrifices, and for what feels like ages, it seems like you're not making any progress. Your friends are sharing pictures from their vacations while you're stuck eating rice and beans. Your coworkers are cruising around in shiny new rides while you're just keeping that old clunker running. The pressure to throw in the towel is huge. But here's something they're not telling you. A lot of those folks posting about their vacations are buried in debt. That coworker with the new car just signed up for 6 years of car payments. They appear successful, but they're really just stuck. There's this thing called the 13th tendency, or the liking tendency. You tend to do business with people you like, even if it ends up costing you. You buy from the nice salesperson. You hire your buddy's kid. You invest with your cousin's company. Your mind often values social comfort more than smart decision-making, and this can really add up over time. I've made my fair share of blunders in business, but I figured out pretty early on to distinguish between liking someone and their actual skills. I really don't care how charming someone is at social gatherings if they can't produce results. A lot of folks never grasp this difference. They keep bringing on board people they like who aren't up to the task, and then wonder why things don't pan out. The journey to 100,000 requires you to be brutally honest about how you're performing, starting with yourself. Are you genuinely saving like you mean it, or are you just making excuses? Are you steering clear of foolish debt, or are you just funding your lifestyle? Are you sticking with your investments during the ups and downs, or are you checking your portfolio every single day and freaking out? Many people deceive themselves. They claim to be investors when they're really just taking chances. They say they're building wealth when they're just treading water. They promise they'll start saving seriously next year, but next year never arrives. The months keep rolling by, and they remain broke. Let me break down what real discipline looks like, because I don't think people truly get it. Discipline is driving right past the car dealership when your bonus comes in. Discipline means turning down that getaway your buddies are organizing. It's about seeing your investments drop by 30% and still choosing to buy more. Discipline involves having to explain to your partner why you're not upgrading the house, even if you could technically swing it. None of this feels great. Discipline doesn't create those picture-perfect moments for social media. Instead, it builds something way more important: options. When you have money, you have choices. You can walk away from a toxic job. You can launch a business. You can grab assets when everyone else is freaking out. You can take smart risks even without cash. You accept whatever life throws at you and keep a smile on your face while it happens. Now, let's talk about tendency and the impact of stress. When you're feeling the heat, you tend to revert to basic instincts. You make choices based on emotions. You look for comfort. You ditch long-term planning. That's why so many people's finances crumble during tough times. The pressure takes over their logical thinking, and they do whatever it takes to ease the immediate discomfort. I saw this happen back in 2008. Folks with solid portfolios freaked out and sold off everything when the market hit rock bottom. They just couldn't handle the pressure of seeing their wealth take a nosedive. If they had just stayed put, they would have bounced back in a few years. Instead, they locked in permanent losses because stress clouded their judgment. The answer isn't about being fearless. The key is to create systems that shield you from your own stress reactions. Set up automatic savings so you can't dip into them. Establish automatic investments so you keep buying even when the market crashes. Make rules ahead of time for when you'll sell, so stress doesn't mess with your reasoning. Most people don't have any systems in place. They just go with the flow. They convince themselves they'll be logical when it counts. But then stress hits and they realize they're not as rational as they thought. By the time they come to this realization, it's already too late. The harm is done. The 15th tendency is availability. It's about misjudging things combined with striking evidence. You remember the dramatic tales and overlook the statistical facts. You know someone who struck it rich in property, so you think that's the way to go. You've heard tales of folks who lost it all in the market, so you steer clear of stocks. Your mind is gathering evidence in all the wrong ways, leaning towards stories instead of facts. The facts are straightforward. Major stock market indexes have grown at about 10% over the last 100 years. When you factor in upkeep, taxes, and transaction fees, real estate returns are actually lower. But real estate seems more secure because you can physically see it. Plus, everyone has a story about their uncle who hit the jackpot. Those anecdotes are drowning out the numbers that should inform your choices. I'm not saying to avoid real estate. I'm just saying don't let those vivid stories overshadow the statistical truth. The dull, diversified strategy usually outperforms the thrilling, story-driven one almost every time. But dull doesn't sell. Dull doesn't go viral. So you find yourself surrounded by captivating tales of rare cases while the unexciting winners quietly accumulate wealth. Let's get one thing straight about what $100,000 really signifies. It's not about retiring. It doesn't mean you're financially free. Honestly, it's not even that huge of a sum when you think about it. What it truly stands for is evidence that you can keep yourself in check. It's proof that you can hold off on immediate rewards. It shows that you're capable of growing your wealth in a world that's set up to take every dollar you make. Once you demonstrate that to yourself, the next 100,000 comes around quicker. Your mindset shifts. You aren't battling against yourself as much because you've developed those mental skills. You've created the habits. You've made it through the tedious times and watched your investments start to pay off. The second 100,000 usually takes about half the time. You're stashing away more because you're bringing in more. Your existing investments are working for you. The numbers begin to align with your goals instead of against them. By the time you reach 500,000, the money you earn from investments outshines your paycheck. That's when folks start saying you're just lucky. They don't recognize the years of hard work that laid the groundwork. The 16th tendency is all about mental compartmentalization. You handle different types of money in various ways, based on random mental categories. When you get your tax refund, it feels like free cash, so you splurge. But your paycheck feels like serious cash, so you're more cautious. However, cash is cash. $1 from a refund is just as valuable as $1 from your salary. Still, you treat them in totally different ways. This habit leads folks to act irrationally when they come into unexpected money. They receive a bonus and instantly blow it on luxuries because it feels like found cash. If they were thinking clearly, they'd see that bonus as a golden chance to speed up their journey toward 100,000. Instead, they box it in as extra and waste it. I've never viewed it that way. Every dollar has the same purpose, to grow or provide essential value. It doesn't matter where it originated. The bonus, the refund, the birthday check from grandma, they all end up in the same pot. Your invested money can grow steadily while everyone else is out shopping. The 17th tendency is all about inconsistency and avoidance. Once you latch onto a certain identity or stance, your mind fights against any change. If you think of yourself as someone who isn't good with money or struggles to save, you'll keep acting in line with that identity, even if it's harmful to you. Your mind would rather stick to being consistently wrong then face the fact that you need to change. That's why I'm not a fan of financial resolutions. Folks say they'll start saving in January. They manage to keep it up for about 6 weeks, then they give up. Come next January, it's the same old resolution, same outcome. They're attempting to alter their behavior without shifting their identity. It just doesn't work. The real change comes from realizing that you're not bad with money. You're simply using a mindset that's suited for a different situation. Once you grasp the psychological patterns that are working against you, you can create strategies to counteract them. You're not changing who you are. You're just outsmarting your own predictable irrationality. Let's chat about reaching that finish line, because folks often get it wrong. When they hit 100,000, you don't magically become wealthy. You don't just walk away from your job. You don't go out and buy a yacht. What actually happens is you keep doing exactly what you were doing before. You continue saving. You keep investing. You maintain a lifestyle that's below your means, because that 100,000 isn't the end goal. It's just the first milestone in a long race. This is where many people trip themselves up. They reach that milestone and think it's time to throw a party. They start upgrading their lifestyle as a reward for their hard work. After spending a decade building up their savings, they ruin their momentum just when compound interest is starting to get exciting. It's like climbing a mountain for hours and then choosing to roll back down because you're feeling tired. The sensible reaction to hitting 100,000 is to do nothing. No celebrations, no lifestyle upgrades, no easing up on your discipline. You just keep pushing forward because now the numbers are finally working in your favor. The returns are starting to get significant. The power of compound interest is really kicking in. This is the moment to speed up, not just cruise along. The 18th tendency can be about fairness. You might think the world should be just. You believe that hard work ought to be rewarded fairly. You assume that doing the right thing will lead to success. This mindset can lead to letdowns because the world doesn't operate that way. There are tons of diligent folks who remain broke and many lazy individuals who inherit riches. Fairness is something we humans created, not a natural law. The game of accumulating capital isn't fair, it's simply math. If you save and invest, compound interest will do its magic. If you don't, it won't. Your level of effort, your moral value, your good intentions, none of that matters. The math doesn't care if you deserve to succeed. It only cares if you provide it with capital and time. I've never counted on fairness. I've relied on probability. I've anticipated that consistent rational actions over extended periods yield predictable outcomes. That's not fairness. That's simply basic math. Yet folks keep hanging around, expecting the universe to reward their hardships, and then they're baffled when it doesn't pan out. The universe doesn't hand out rewards for suffering. It pays off on building capital and having patience. Let me share the final framework, the one that brings everything together. I like to call it the lattice work of mental models. To make wise financial choices, you've got to grasp psychology, math, economics, and biology. Most people rely on just 1 or 2 mental models from whatever they studied. That won't cut it. You have to understand compound interest from math. You need to get the idea of incentives from economics. You've got to recognize cognitive biases from psychology. You ought to be aware of evolutionary mismatches from biology. When you merge these models, you can clearly see why many people struggle with money and what changes you need to make. The psychology shows you the pitfalls to dodge. The math reveals what actually works. Economics explains how systems operate. Biology reveals why your instincts can lead you astray. When you combine these two, you create a solid foundation for making rational choices that many folks never really grasp. It's not rocket science. A clever high schooler could wrap their head around every idea I've mentioned. However, just because you understand something on a mental level doesn't mean you'll act on it. Everyone is aware that they ought to save more and spend less, yet hardly anyone actually does it. The space between knowing and doing is where wealth slips away. The tendency of science can mislead you. As you age, your brain's abilities may decline, but your confidence often remains intact. This makes older individuals susceptible to scams and poor choices. It also impacts younger folks who think they'll always have time to save later on. Your body and mind are assets that deteriorate over time. Every year you delay starting is a year you can't reclaim. I've seen people squander years convincing themselves they'll get serious about saving once they reach a certain milestone. As soon as they land that promotion, once the kids finish college, or after they settle the car payments, that big moment never actually arrives. And when it finally does, a fresh excuse pops up to take the place of the old one. Before they know it, they're 65 and freaking out because they've got nothing to show for it. You can't reclaim those years. Compound interest requires time, and time is the one thing you can't purchase more of. Starting at 25 instead of 35 or 45 makes a huge difference. It's not just about having more savings, it's about having more periods for compounding to work its magic. Every year you put off saving costs, you weigh more than the previous year. The harsh reality is that when you're young and time is on your side, you don't feel that sense of urgency. But when you're older and that urgency hits, time slips away. That's why I'm so passionate about urging young folks to kick things off right away. Not next year. Not after they clear this one hurdle today. Because while you're waiting for those perfect circumstances that will never come, you're wasting your most precious resource. Let me wrap this up with the only piece of advice that truly counts. If you're looking to create wealth, there are 3 things you need to stick to consistently. First off, steer clear of catastrophic foolishness. Live within your means and put the leftover cash into assets that actually produce returns. That's all there is to it. Everything else is just background noise. Steering clear of catastrophic foolishness means no high-interest debt, no gambling that you try to pass off as investing, no purchasing assets that lose value with borrowed cash, no panicking and selling during market dips. Just don't sabotage yourself. That alone takes care of about 90% of financial mess-ups. Living within your means isn't about being stingy, it's about being sensible. Every dollar you spend trying to impress people you don't even like is a dollar that could have been working towards your freedom. Opt for freedom instead of status. Choose flexibility over comfort. Go for long-term growth instead of short-term gratification. The numbers don't care about your emotions. Investing in productive assets means acquiring things that actually yield returns. Investing in stocks and solid companies, index funds, and real estate that generates cash flow. Forget about collectibles, cryptocurrency, or whatever your friends are hyped about. We're talking about those steady, productive assets that have been building wealth for ages. If you give them the chance, they'll keep growing for you. The first 100,000 is the big hurdle. It's a test to see if you can hold it together long enough for the numbers to work in your favor. A lot of folks stumble at this point. They just don't have the self-control, the patience, or the clear thinking to make it happen. They spend their lives coming up with reasons why they can't save while splurging on things that keep them broke. But if you can get through this challenge, if you can create that initial stack of cash through years of unexciting discipline, everything shifts. The curve of compound interest starts to rise. Your money begins to earn more than you can set aside. The mental weight eases up because you're finally witnessing progress that reflects your hard work. And here's the kicker that no one talks about. Once you've built genuine wealth and you've witnessed how compound interest truly works over the years, your desires start to change. That flashy car seems pointless. That pricey getaway feels like a chunk of compound interest you'll never see again. Your priorities shift because you've encountered something far more fulfilling than just buying things. The security and freedom that your wealth offers. That's the real prize, not just the figure in your bank account, even though that's pretty cool too. The true reward lies in the mental shift, from being a consumer swayed by every ad and social influence to being a capital allocator who makes smart choices based on long-term strategies. You evolve into a whole new person. So here's my final thought. Get your first $100,000 through any honest and legal means you can. Slash your expenses to the bare minimum. Boost your income in any way possible. Tune out everyone trying to sell you stuff. Ignore those who criticize your old car and modest apartment. Just focus on getting it done. Until you have some capital, you're not really in the wealth-building game. You're just trying to survive. And let me tell you, the survival game is stacked against you. Any little emergency can take you down. A downturn in the economy can wipe you out. A terrible boss can keep you under their thumb. But once you've got some capital, you're in a whole new game. You've got a safety net. You've got choices. You've got the time to make smart decisions instead of panicking. You might not be wealthy just yet, but you're no longer at the mercy of others. And that shift is everything. Don't think it's going to be a walk in the park. Don't expect it to happen overnight. Don't count on anyone to support you or cheer you on while you're at it. Building wealth is often a lonely, tedious, and unexciting grind that can take years before you see any real progress. A lot of folks give up because they can't deal with the wait for rewards. But if you can stick it out, if you can outlast your own impatience and irrational thoughts, the numbers will add up. They always have. Compound interest doesn't care about where you come from, your luck, or who you know. It only cares if you provide it with both capital and time. If you do, it can lead you to wealth. If you neglect either one, you'll remain broke no matter how clever you are. The decision is up to you. You can keep making excuses, spend every penny you earn, and wait for someone to come to your rescue. Or you can recognize that the game is straightforward yet challenging and start taking it seriously today. Not next month, not next year, but today. Because every day you delay is a day of compound interest you'll never reclaim. When you look back on your life, you'll either be grateful for the discipline that brought you freedom or regret the excuses that held you back. So stop reading, stop researching, and stop searching for shortcuts. Just take action. Save diligently. Invest wisely. Wait with patience. The first 100,000 is the toughest to reach, but it's yours to earn. And on the flip side, there's a way of living that the majority of folks never experience. It's a lifestyle where your money does the heavy lifting for you, rather than you grinding away for your cash.